All right, so in the Money Show today, we are going to talk about the market movement. So, Indian equity markets have remained highly volatile for quite some time now. The heightened volatility has spooked retail investors who are now wondering at how they should invest their hard-earned money. There's also a belief that it is time to exit mid caps and small caps as they fail to make money in volatile markets. Now, if you are someone who's confused what to do in the current market scenario, then don't worry, the Money Show has your back as always. Let's bring on board Srinivas Rao Ravuri, CIO Equities at PGIM India Mutual Fund, who will answer all of your queries. So do catch in this chat. All right, Srinivas, good evening and welcome to the ET Money Show. And today we're going to talk about the market's current movement and also the future investment strategies that the investors need to really lock in their portfolio. Let's talk about mid cap and small cap first, because that's one category that's troubling our investors. In last 3 months, the mid cap and small cap index, if we see, have been minus 4.3, minus 4.5%, obviously owing to the market volatility. But going forward, a lot of analysts and researchers are actually giving complete exit calls from mid caps. How are you looking at it? How are you sensing these two particular categories?
Sure. Thanks for having me here, Kavita. See, mid and small caps as a category have maximum, I would say, promising returns. But these categories have their own associated risk, so to say, in the sense when markets are doing well, when sentiment is positive, mid and small tend to do extremely well.
Right.
See, these two categories are relatively less liquid. As you know, when you're buying a stock which is less liquid and more people are buying to buy than sell, automatically prices tend to move up sharply, and you can say valuation get a little bit inflated. In a buoyant environment, when markets are doing well, mood is positive, people are excited to buy. In addition to funds, even individual retail investors are saying that I want to buy new stock, I want to look at that stock. All that tend to create its own hype around mid and small caps. So, and when what we are witnessing right now is, I think, almost 16 months of consolidation. Markets not going anywhere.
Yeah.
So when the large caps are not doing anything, there is a bit of tiredness that comes into the market, sets in, and few investors are, they want action every day. Markets are going up, whereas here markets are flat.
Right.
So they are trying to get out, and mid and small cap tend to underperform.
Right.
I think what we are witnessing is also same thing.
Okay.
But if you see, finally what drives stock prices, whether it is mid cap or a large cap, is their underlying profit growth.
Right.
So historically also, mid caps and small caps have delivered higher profit growth.
Right. Yeah.
So, but interesting aspect is, may not be all 500 mid caps will deliver good growth, but within that the select 100 will deliver better growth. So to that extent, when you are doing investment in a mid and small cap, I think investing through a mutual fund is far better than investing directly, unless you know the company in and out as a retail investor.
Right.
Because if you look at the category per se, that consists of, let's say, 250 companies. So some companies will do well, some companies will not do well. But by their very nature, mid cap companies will deliver higher top line growth and profit growth.
Right.
Because in India, even today, many categories, the category, let's say tires is one category, batteries is one category. The largest company in this sector is a mid cap company.
Right.
So I think growth would be definitely higher in mid and small cap companies.
Okay.
But it is important to A, select right fund, right stock. B, equally important or more important is, please have a longer horizon. 3, 5 years. If you come into mid and small cap with a 6 months, 12 months, you are bound to be disappointed. So I think that needs to be avoided at any cost.
But then what about those investors who've seen bumper return in last 2-3 years in the same space, in the same category, and now are slightly disappointed? Do you recommend them to pump in more money and stay invested for long?
See, that depends on their asset allocation call, what their financial advisor is doing. But in general, I would say that, it is not a bad idea to book profits in general.
Okay.
Yes,
Okay.
it is, when, if you've delivered, let's say, great returns, we all love to see. One is, notional profits. Other one is when you actually sell, money is in your bank account. You feel good to see that.
Yeah.
To that extent, it is not a bad idea to book profits. But, if your horizon is 5 years, you've seen, let's say, last 3 years have been great. So I've made 50% return. Let me book profit.
Yeah.
You book that, put money in bank, and next week you want to buy one more stock or invest again, then it is not a good idea at all.
Yeah. Yeah.
So I think as long as you maintain this balance, it is not bad idea to book profits. B, if your horizon is 5 years, if you see whatever we see today has gone up as a 5x, let's say 10 years. But it is not a one-way street.
Right.
Those also have seen corrections.
Yeah.
But, you are trying to time, then, you, instead of making 500%, you made 50%, then got out, and then you are repenting, why did I get out? So I think it is important to keep that horizon in mind, whether I'm there for 5 years or I'm there for 3 months.
But then talking about valuations, do you think they are really real right now or slightly overvalued?
I would say they are not cheap.
Okay.
Yeah.
Okay.
They're not cheap. As a fund manager, we would like to buy them at a, when price goes down, many times actually happy because I'm able to buy company that I like at a better price.
Better price. Yeah. Right. Right. But then talking about the overall mindset that people have, about having the right entry time into the market, with so much of volatility around, should one be entering right now or should one just wait?
So again, what we recommend to investors is a staggered approach.
Right.
So you want to put in, let's say, 5 lakh, don't put in one shot, put in over a 3 months, 6 months. There are various methods available to do that in a systematic.
But then you need courage to enter the market in so much of volatility also. So, why is it important to have this kind of a strategy, and also for the SIP investors? Because the mind works in a very tricky way, in a very funny way. When you see so much of fear around you, you just might as well stop your SIPs also. That's what people do all the time.
Whereas one is supposed to do exactly opposite.
Exactly. There's a time when you can actually accumulate units. Why is it so important? What is the maths in terms of example, if you could explain?
Same thing, let's say a particular company, you like the company, it is available at 100 rupees, market is doing well, and it goes up to 120 rupees, and then goes to 150. So next time you have the same, let's say 10,000 rupees, in the first lot you bought at 100, when market actually moved up, you are not able to buy same number of shares, you will actually buy less when markets are going up. It works other way when markets are going down, and that is where I am saying it is important to have that courage. In fact, I have one very simple funda while investing into stocks. Whenever I'm buying a stock, I actually seriously evaluate if that stock goes down 30%, will I buy more or sell? If I think that I will sell, I will not buy that company.
Okay. Okay.
So I should have that conviction that the company's fundamentals are good, prospects are good. So I'm buying at a particular price for whatever reasons in the coming months. The stock price actually falls. It becoming more attractive. So I should be adding more, not selling in panic.
Right.
So I think that's what investors also need to exercise. First, you allocate a certain portion of money to this. You talked about courage. So the best thing to do is to put money in bank FDs, which is zero risk. But you've seen the returns that mutual funds have delivered, far higher than a typical FD has delivered. Most people are struggling to beat the inflation. Whereas the moment you get into equities as an asset class, equity mutual funds, we have delivered very good returns. But there is an associated risk with that. But that risk gets amplified when you're looking at a 1 year, 2 year. But when you look at a longer horizon, there is hardly any risk. So to that extent, yes, courage is needed because you will make higher return. I'm saying you are rewarded for the risk that you're taking.
Right, right. So are you taking any risk when it comes to your funds? Are you playing it up that well that, in the longer run, it's going to give benefits and returns to the investors?
Absolutely. That is what I think. We are here to take risk. We are, when I'm buying a stock, not me, anyone who's buying a equity stock, he is taking a risk. If he is thinking that he is not taking risk, he is fooling himself and others also. So the moment we are buying equity as an asset class, there is an underlying risk. Our job is to take minimum risk. Not we have a philosophy saying that growth at reasonable price. So, and we follow certain rules to make sure that we avoid big mistakes. We can't avoid making mistake. Let's be clear. When I'm, but at the same time, if I can avoid making big mistakes, for example, even in something like a Nifty, the supposed to be large, liquid, relatively safer bets. Even in last 1 year, there are some stocks that are down 50%.
Right.
So there is a risk very much there. So if we can avoid making such big mistakes, I think half of my job is done. So to that extent, I'm taking risk every day, but I believe I'm taking a calculated risk.
Okay, all right. So let's translate this into action mode. What are your favorite sectors and the type of companies that you're looking at?
Yeah, I would say, so as I mentioned, growth at reasonable price. Like
Right.
I want to invest in companies that are growing, because investing into equities is all about growth.
Right.
But at the same time, I don't want to overpay for that growth. So that's our investment philosophy at PGIM.
Okay.
And right now, I would say two sectors that clearly fit into that framework are financials and pharma. In financials, I'm saying after last 4-5 years of tough times, we're actually seeing a fairly decent credit growth, retail and corporate. So growth is there. The credit cycle is behind us. So NPS are very low. So as a result, profit is pretty good. So profit growth is there, not just top line growth. And C, the price that I'm paying, if I see versus historical average or versus the broader market, is, I would say, is very attractive. And that is where I have the higher comfort that the risk that I'm taking and the return that I expect is definitely in my favor. And then comes the pharma. Pharma, I would say, is a relatively defense bet, given the kind of uncertainties that we are seeing all around. So here, pharma business is relatively insulated. Whether there is a recession or not, the consumption of medicines will not change per se. So, and also these companies have at least two drivers. They are not dependent on only India.
Right.
India's all the large cap companies over a period of time have invested significantly to diversify their revenue stream. So only some part comes from India and the rest comes from exports.
Okay.
And in exports also, it's not that they've started this journey today. They've started this journey 10-15 years ago and made reasonable progress in those markets. As a result, there is a very high visibility on revenue growth. So I think growth visibility is there irrespective of what happens to economies, including the developed countries.
Okay.
And B, I think valuations are reasonable. So I think that's where these two sectors are the most preferred right now.
So in terms of triggers, when we talk about India and India growth story, what are those triggers that can actually ruin our mood or even derail the growth story?
See, the fundamental issue is finally we are buying companies. As a fund manager, I'm investing in companies. And I'm, as I said, I need growth. And as we can see in the third quarter, we have seen certain pockets have disappointed us on earnings. We call India consumption story, but certain consumption stocks have delivered zero volume growth. Or a lower single digit volume growth. And these stocks are trading at 60-70 PE. So there is a clear mismatch there in terms of risk reward.
Yeah.
So to that extent, overall, we are definitely seeing certain pockets being weak.
Right.
So which means growth is questioned. I think if growth is questioned, everything comes to a standstill. So that is the number one concern that I have when it comes to companies. I will not say valuations are so much of a concern. Yes, we are trading at a significant premium to emerging markets. I think we will continue to trade a premium because India is not a 1 quarter or a 1 year story. I think it's a next 5-10 year story. So whenever that visibility is higher, markets will tend to trade at a premium. So I don't think that will go away. But the other thing I would say is, globally, last 30 years, we were in an era of easy liquidity. And from there, we are moving to quantitative tightening, inflation. So whether in the next few months we can expect a lot of FIs investing into India, answer may not be.
Right.
The risk appetite is different. When they are making 4% risk-free return there, why should they come to emerging markets like India?
Exactly.
So I think so that can play out.
Yeah.
Also the fact government is also very much aware. Our trade deficit, it's not a great position to be in. So I think it's not that everything is great, but many things are in our favor.
Yeah.
But I think wherever things are not okay, the good part is government is aware of it. and they are working on it. So to that extent, I would say things are manageable, but at the same time, it is not fair to think that everything is great.
Everything is great. Exactly. Now, talking about the equity portfolio that investors might have, we understand that a lot needs to be decided as per your financial goals, the kind of asset allocation you have. But then within equity, where do you think is the time to go heavy?
So that depends on the risk appetite. I'm saying someone who has a higher risk appetite or a longer horizon, mid caps will, I think, will deliver better returns over large cap and other categories. Small can deliver higher, but I think mid and small stock selection becomes extremely important for retail investor. Fund selection becomes important. Whereas if you're investing in a large cap, I think it is relatively easier segment to invest in.
You think any hybrid kind of a strategy would really help investors?
Absolutely. So I think that is what hybrid is all about. I think there the fund manager fund is expected to make the change in terms of their exposure to equity versus fixed income and other, depending on what is looking better on a risk reward basis. So to that extent, for when an investor who can't make this choice of moving from fixed income to equity, investing in a hybrid fund, which will do that, makes immense sense.
I know we are supposed to talk about just equity, but then when we talk about diversification, is it a time to go slightly heavy even in fixed income?
I think so. I think when you are looking at the returns of 7% plus, fixed income is not a bad option at all. I think after 2-3 years of relatively muted fixed income story, this is a good time to have some allocation to fixed income for sure.
One last question to you. Right time to exit a fund. What would that be?
No, it is more to do with investors, their risk appetite and their financial goals.
Okay.
I don't think there is any right time to exit a fund.
But then we talk about performance or comparing them with the peers or with the index. How should we take that call?
So I think when you are evaluating a fund, the fund house, the process, the performance and people, all these are important. All 4 P's are important.
Right.
And whenever you see you have an issue on these 4 is when one can take a call. I'm sure channels like yours are doing a very good job on advising people on how to go about in selecting both when to enter and when to exit.
Definitely. Talking about the inflows, what kind of inflows is your AMC witnessing? If last few quarters I would want to consider amidst all these volatility, are investors preferring lump sum investments or the numbers of SIPs, which we know have gone high lately? But then what's the trend in your AMC? And
so as many of you know, PGIM is relatively a new entrant. We are one of the fastest growing mutual fund. So we are continue to see a fairly healthy pace of SIP flows into our funds. So and that trend has been pretty healthy.
All right. Thank you so much for removing time today, Srinivas. Thank you.
Thank you for having me here.
Thank you.